Rick, can I interrupt you there for a minute?
Yeah.
I think the right answer would have been talk to Blaze and Frank, have them sell your house, buy you a bigger house, and then we'll talk about paying that down.
Yeah.
Let's practice this together now.
Right. Right. Frank, I really screwed that up. You're right.
You're not following the rehearsal routine here, Rick. All right, JJ.
Hey, Blaze Rosser.
Hey, it's another KLT Thursday. What's KLT stand for?
KLT, Know, Like, and Trust Thursday.
Hey, if you're going to do business with people, you got to what?
You got to know them, you got to like them, and you got to trust them.
So each Thursday, we're trying to highlight different people that we network with, that we know, we like, and we trust.
People that we use ourselves.
Oh, absolutely. We see them on a weekly basis. So we want to get that across to anybody that we may know that these people are tried and true.
Right.
So without further ado, let's bring in our guest.
I have a pleasure. Thanks for having me on. This is great.
No problem. So here's what I want to talk about today. Interest rates. Interest rates from a home standpoint are extremely low, which I'm going to guess on an investment standpoint, they might be a little bit higher. So what I want to talk about today is I hear a lot of people either wanting to pay off their home faster or pay off their home just in general. So if I can borrow money on a mortgage, whether I'm refinancing or paying down my mortgage, if I can borrow that money at 2.75%, is that a good financial decision when I could have that money outside of my home as a financial vehicle and possibly make more? And what is the safety factor? So I'm going to pass that off to you and have you give me your initial thoughts on that. We'll go from there.
Yeah, great question. And I talk about it with clients recently quite a bit. And, so when I talk with clients, I'm pretty big on like specific goals. Because like there's always good, hey, there's a 2% rate, I want to refinance, or should I invest my money? And like there's these broad things that they have but when you get more specific about like, well, what else is going on with your goals, with your financial plan, and like what else is going on, that seems to peel the onion a little bit more to make a little bit more informed decision for the client, just knowing a little bit more what's going on. So with a lot of my clients, like when we do like financial planning for them, I always tell them your investments are one piece of the puzzle, but there's a lot of other things going on to make sure you're successful. One thing I'm big on, I'm a big debt hawk. I don't like debt, not for myself, not for my clients. And I know that a lot of times debt is, you need it, okay? And especially when you can borrow it at 2%, frankly, it's a good investment. If they're like, Rick, I want to pay my house off, if that's a goal, then I'm saying, but Rick, I have extra money. Should I invest this with you and earn more, or should I pay this off? Either answer is fine, but at the end of the day, I would tell them, you just told me you want to pay your house off. So pay the house off. If you're going to be in the house for a while, you're just paying 3.5%, you got it down to 2.5%, and it's important for you to pay that down, take the extra money and pay it down.
Rick, can I interrupt you there for a minute?
Yeah.
I think the right answer would have been talk to Blaze and Frank, have them sell your house, buy you a bigger house, and then we'll talk about paying that down.
Yeah.
Let's practice this together now.
Right. Right. Frank, I really screwed that up. You're right.
You're not following the rehearsal routine here, Rick.
You're right. They should absolutely talk to you guys and then take the next off. No doubt. Right.
Most people, what they're concerned with is worst case scenario. What if the market tanks and crashes and burns? What do we do? Well, my answer is we experienced some of that back in 2008. And what destroyed the housing market was that a lot of people did have a ton of equity in their home or even paid it off. But what happened was when the market crashed, they wanted the ability to grab that money and use it to pay other debts or use it as an income for a short period of time. But they couldn't, because guess what? When the market crashed, all the banks tightened up and their underwriting guidelines said, you can't have your money.
And even if they had it on an equity line, the banks shortened that equity line. They brought that cap down.
They did, yeah.
They didn't have it to use. So that if they have it someplace a little bit more liquid, they have access to it.
Well, just think about it. If you've got equity in your home and the market crashes, and number one thing, you lose your job, what do you have to get a loan on your own house? A job.
Not in 2008, you didn't need a job.
Oh, yes. Well, in 2007, you didn't need a job. If you could fog a mirror, you could get a loan back in 2007.
Right.
What I'm getting at is you having the ability to pay off your house is so much more important than actually paying off your house. And putting that money in a separate account is what I'm trying to get at. Why we have Rick on the phone, or the phone, I'm talking real old school, on the video call. Putting that money in a different vehicle is what I want to discuss with Rick. How could we take that home equity and keep it in a safe place where we have access to it, even if things crash and burn?
Let me get this straight. So what you're saying is, if you aren't going to buy a bigger house and you have a lot of equity in your home, and I've got it already at a low rate, say I've got 2 or 3%, which I'm getting a tax deduction on. If I take that money out at 2 or 3%, I still have that tax deduction. And if I put it someplace that's earning me 3, 4, 5, 10%, and yet I can still grab that money when I need it, I'm better off. Is that what I'm hearing?
Hey, when you lose your job, how are you going to get that money if it's in your house? If it's with Rick, all I got to do is give you Rick's phone number.
Right. Okay.
Well, so there's a couple things here. So one, back in 2008, that was a structural financial crisis. Like the banks caused that crisis. Okay. That was the bank's fault. We just had another downturn last year, pretty fast and furious. Now we came back out of it a lot quicker than we did in 2008, but it was the fastest downturn, one of the fastest downturns in history. This time around, the banks are going to help us get out. But when the market falls either way, let's say housing prices decline. This is the opposite. Housing prices are up. The markets are way down. With houses prices down, and like it's a whole just economical collapse. Houses market is down. The stock market is down. If you got your investments with me, yep, they're a little bit more liquid, but they're still subject to market risk. So, I'm a big explainer of setting expectations and understanding what clients are going to get into. Yes, especially with rates right now at 2% or less, especially at the bank, you're losing money because of inflation. But if you have your money with me, yes, the potential in the right amount of time, we're going to grow your assets. We are. But life happens to us all. There could be a case where, hey, Rick, I need this $10,000 I wanted to invest. Well, the market's down 13, 14% because A, B, C, or D, and now you're $10,000. Now I got $750 here for you. Okay. The other thing to understand is this: if you were to take that $750 while it's down, now if you need it, you need it. Okay. If you don't really need it, but you want to take it because you're scared, that is a loss. You haven't lost anything yet because your statement's down. I bought my house for $250, market crash. Now it's worth $125. Is it? Did you sell it for $125? No. It just looks like that on paper.
Right.
Quite frankly, when the market dips and you have money in investments, I can only build wealth, and you, the client, can only build wealth if you put some money in and buy more shares that are inexpensive. Because that's all it is. If you've got a relative time frame that we've discussed and the market takes a dip halfway through, Rick, my goal was 10 years, it's year 5, the market's down 23%, I should pull out. No, you should put in more money, because what's the percentage of time that the markets come back from a downturn?
100.
100. So put some more money in, if anything, or just wait it out, and it will come back.
All right.
I love it.
That's good.
That's great stuff. So if you're out there in TV land or internet land or whatever you call it, and you're watching this, if you're thinking about hiring a financial advisor, reach out to Frank or I or Cheech, whatever you know him by, and send us a private message. We know how to get a hold of Rick. We're going to put you in front of him and get you talking to somebody that we know, like, and trust.